Are you looking for high yield and successful investments in the current market environment while reducing some of your risk? Stick with me as I go through some of the options here. Following up on a question, which would be better, Arbor Realty or Medical Properties Trust in terms of managing some of this risk? Possibly one of the key points here is in both cases we're looking at relatively high yields and a relatively higher degree of risk. So neither of these options, I think, are going to be what I would call low risk, but I think they have different attributes here to be careful and considerate about. So what are some of the key points here that you need to remember? Now, perhaps one of the first elements here is Medical Properties Trust has diversification, yes, but it has 55 tenant relationships and 444 properties over 10 countries. But there's still quite a bit of concentration or concentration risk, particularly when we consider their main tenant, Squibb, which represents roughly 1/3 of their portfolio and incoming rent. On the other hand, Arbor also has quite a concentrated portfolio. Most of their loans, the overwhelming majority, are bridge loans. Most of these are multifamily. However, they do have some really nice geographic spread here as well. In general, I do enjoy a company that is growing and going from strength to strength. And here we can see with Arbor at least, they've been growing that dividend payout and generally those distributable earnings over time. They've maintained a really healthy payout ratio that I think is safe and relatively secure. Now, my personal preference is to bank on a company that is growing because they're more likely, as long as they're not being overly aggressive, they're more likely to continue to do well. Also at Arbor, they've got a very strong focus here on risk management. So not only have they been consistently growing, but they've also been very careful with their risk mitigation approaches. And when you read through the earnings transcripts as well, that's been something that they actively manage. It's been something that they constantly talk about is security, is safety, and risk management. And for me, that's something I like to see as an investor. Now turning over to fast graphs for a couple of reasons here. Number one, if we look down here at the analyst estimates for the AFFO, essentially the sort of like the earnings for the company here, but for a REIT. We can see over the last 6 months that the analysts have been progressively reducing the AFFO estimates for 2023, 2024, and also quite aggressively down in 2025. And so this blue line here showing the AFFO, if we'd plotted that out in the past, it would have been going up a reasonable amount, and now we're seeing that drop down. Now what this has done is it's compressing this estimated dividend payout ratio. Now this is assuming that the dividend is paid out. Now AFFO is also expected to decline quite considerably here in 2023 for a REIT, and I guess that's down to the difficulties that MPW has had with some of the tenants in collecting the full amount of rent owed to them. Now it's also worth noting here as well, with a dividend yield of currently about 15%, the market is pricing in a lot of uncertainty. There's a huge amount of uncertainty here, and that can come with great opportunity, but it can also come with some actual serious risk to you. Now switching over to Arbor Realty Trust also on fast graphs. First of all, I just want to look at the analyst scorecard here, which is an absolutely marvellous here for the analysts. So normally the company will beat analyst expectations over a two-year forward estimate. Over a 1-year forward estimate, usually the company is going to trounce again the analyst estimates with the results. Sometimes the analysts get it right, and very rarely do the analysts get it wrong. So we're talking about a company here that is reasonably easy and tends to over-deliver. Now, going here to the adjusted operating earnings, we see there's an estimated decline here for the analysts in 2023, but at the same time, when we look down here for the earnings, we actually see the analysts are expecting the earnings to go up, and they've been revising those earnings upwards as well over time. And so that blue line, rather than going downwards here, as we would have seen a while ago, we're now seeing that get revised upwards as analysts expect stronger and stronger earnings. Now remember, that's also what we sort of see from the analyst scorecard, is the company does better than expected. Now there has been a very steep sell-off. I've been using that personally as an opportunity to add to this company into my holdings in this company. Now, bear in mind, it is a relatively small company here with a $2 billion market cap, but in general, as I say, they've been growing and they've been growing well. Now, what can happen with the company? And this is, I guess, one of my challenges with MPW at the moment, is you can experience quite a steep decline here in share price. Now, this is Algonquin Power and Utilities Corp, AQN. I also have shares in this. Now, they had a history of fairly aggressive and I'd almost describe it as, walking a tightrope. Here, they aggressively grew. They used quite a bit of leverage and debt here over time, and they continued to grow their dividend. And we can sort of see that dividend, that white line, going up quite aggressively. Up until the 2021 and 2022 years, we could see in 2021 that the payout ratio was getting very elevated, and then in 2022 it became unsustainable. And what we can see is that steep decline there. Now, look, you could dollar cost average, but just remember, just because you're dollar cost averaging, it doesn't mean that there's going to be some sort of bounce or recovery in that company. It's possible that a company goes to nothing. Think Kodak with films a while ago. Think Enron, WorldCom collapse in the early 2000s. Collapse can be permanent when you're buying single companies. Now, a simple way of getting around that is to dollar cost average into an ETF, where you get the diversification over a huge basket of companies in many cases. But look, even if we had held this and we'd bought it at the peak and we'd held it down to today, we'd have lost roughly 50% of the investment that we've made. Now, one of the beautiful things about that is we've lost half our money, and not only that, but we can sort of see this white line here, the dividend, massive cut in the dividend here as well, following that decrease in earnings. Now, could this also happen to Medical Properties Trust? Is it possible that we see a sort of an expectation here of a dividend cut on the cards from this steep decline in market prices that we've seen with MPW? And the answer is possibly yes. There are some suggestions that perhaps the amount of money available for distribution is shrinking faster than we might anticipate, and leaving that dividend coverage very, very, very light if there's full coverage of the dividend at all, and I'll get into that in future videos. But if they were to cut the dividend, we'd see a sort of a revised estimate here of whether or not that's a reasonable value. And you'll see here, in the same way that AQN has not bounced up, they're sort of now trending at a reasonable price. I think over time they'll probably trend up a little bit more, but we'll probably see the same sort of effect with MPW, where they could, if they have a dividend cut, it may not recover fully in the share price. So that means all the money into MPW could just, basically stick at this level for quite a while they sort of recover, and that could, I think, take years. Now, as a personal disclosure, yes, I have shares in a position in Arbor, in MPW, and also here in Algonquin and AQN. I'm holding them all for slightly different reasons. I will concede that I have been adding more aggressively into Arbor and to MPW. Also, though, with MPW, I've also used a variety of options there to defray some of those risks. Both some relatively near-term options as well as some sort of longer-term options as well. And again, those are elements I'll cover in other videos. Now, I think one of the key things there as well with MPW is I'm relatively happy with the current price. I think the current price is baking in a lot of risk there for us. And when we begin to look at MPW again, switching over to AFFO, I think that decline in price is baking in and reflecting a lot of uncertainty in the market. Again, I suspect this uncertainty is relating to a potential dividend cut that some market participants are wary and careful about, and that's one thing to take into consideration. There is a reason for the steep decline, and I wouldn't completely discount that. Now, what do you think? Hit me up in the comments down below. Which of these three do you think are the best options here? Now, I've got, obviously, mortgage REIT, equity REIT, as well as AQN utilities. So they're quite different companies, but certainly if we look at MPW and Arbor, which one do you prefer and why? Hit me up in the comments down below. Let me know.